In this recording, we're going to be looking at the taxation of companies. Now, companies are obviously a very large area of law, and the taxation of them can be quite complex. First thing we're going to look at, really the first step with companies, is determining residency. And now the rules of residency are different from what they are with individual taxpayers, and there's lots of facets we have to take into account. In this problem scenario, we're looking at a company that is incorporated overseas, so in Singapore here. It's a public company, it's listed on the Singapore Stock Exchange, and we're going to try and determine whether or not, even though it's incorporated in Singapore, whether or not it is still an Australian resident for tax purposes. And 51%, so a controlling stake of this company, are held by Bravo. Alpha is incorporated in Singapore. Bravo is incorporated in PNG. And that company that's in PNG carries on a business both in Papua New Guinea, in Port Moresby, and in Tasmania, Australia. And that second company, Bravo, is a wholly owned subsidiary of a third company, Charlie, which is both incorporated in Australia and controlled by Australian residents. And so the question here that we're going to try and answer is, so we'll look, is the first company, the one that's incorporated in Singapore, actually Australian resident for tax purposes? We're going to examine that, and then we're going to also look at the degree of control that that each of the directors or the board have in those situations, and some contemporary case law. So the first thing when looking at the taxation of companies is really to just state, well, why are we bothering to do this test? And fundamentally, it's because the Australian, if you're Australian resident, you're going to be taxed on your worldwide income with offsets, depending whether or not there's a double tax arrangement with other countries. But fundamentally, non-Australian resident companies are only going to be taxed on their Australian sourced income. Now, the rules for determining whether a company is a resident or not are still set in exactly the same section of the Income Tax Act, the old Act, the 36 Act. Definition section is number 6, and the definition of residency for companies is 6 subsection 1, and it's the second half, it's subsection B. Now, a company that carries on a business in Australia and its board is controlled by Australian residents. It's really that concentration of voting power. If both of those things are true, a company is going to be deemed to be Australian resident. Now, additionally, any company that is actually registered in Australia, so that is basically governed by our Corporations Act, is also going to be deemed resident. So it's a disjunctive test. There's essentially two limbs. Now, usually this idea of central management and control is about where the managers meet and they exercise their roles, their powers of management. And there can be multiple situations where this is the case. The board could meet in multiple places. And so that really is a question of fact. We're trying to determine which one is the highest, the most important, and that the phrase they use is the superior directing authority. In situations, though, where a board is essentially just carrying out mechanically, without really contemplating or thinking for themselves, just following the instructions of an Australian resident, then in the more recent case of Bywater, then in that situation, that central management control is still going to be deemed to be in Australia. Now, in this problem scenario, as stated, the company that we're looking at is incorporated in Singapore. So that first half of that test in section 6, that the company is incorporated, isn't going to apply. So really we have to look at that second component, which is that it both carries on a business here and its voting power is controlled by Australian residents. And the problem doesn't in any way, shape or form state that that is the case, that it is carrying on a business in Australia at all. And so by default, it's not going to be Australian resident, it's going to be resident in Singapore, and it will not be taxed on its worldwide income. It's only going to be taxed on its Australian sourced income. However, if it in fact did carry on a business in Australia, we would have to examine the thing in a little bit more depth. Why? Well, because there's two elements in this second limb of this residency test, and so in order to be resident, you have to both have the business carrying on in Australia and have the management and control here as well. So that if they're carrying on trading activities here, sure, they can, as a question of fact, they can tick that box. They will be deemed under that part, but we still need to determine whether or not management and control is here as well. So in order to do this in the style of problem, we've really got to go through this chain of companies. The second company we referred to, the one that controls 51% stake in Alpha, is Bravo. Now, it's incorporated in PNG, so we have to look at its own residency state. And so if this particular business, as stated here, has its business in Australia and has its own management and control in Australia, it will be deemed to be Australian resident as well. And so carrying on down that train, we have to now look at the third company, Charlie. Why? Because we have to determine, in order to determine whether Bravo is managed or controlled by Australian residents, we have to look at Charlie. Now, Charlie, the facts state, is in fact both Australian resident, it's incorporated here, and management controls here. And so these guys control Bravo, and Bravo in turn controls Alpha. So in this particular situation, if Alpha has a business in Australia, it's going to tick that second half of that rule. And so in that situation, it will be deemed to be Australian resident. Now, you may look at this and think, well, that's something of a problem. Why? Well, because all companies that are registered in a particular country are going to be Australian resident in that particular country. Singapore has quite similar rules to Australia. And so it's going to be a dual resident. It's going to be both a Singapore resident company and an Australian tax resident company as well. In those situations, we have to look to the double tax arrangements between those two nations. These are treaties that two countries come together, sign and then ratify. They turn into legislation themselves. And the next part of this question is looking at what would happen if Alpha, this Singapore listed company, is in fact accustomed to voting in a certain way. It essentially does or follows what another Australian resident entity, be it a company or an individual, does, and also assuming here that they have a carrying business here as well to some extent. How does that work? And really, there's two strands that we would go down, two things. They come from two cases. And in Esquire, there was a Norfolk Island company, registered company, and it had board meetings there that were, they were pretty strongly influenced by the residents of Australia. However, the court there said that, look, they suggested things, but the board didn't always necessarily follow those things. It didn't have to, and it didn't, as a matter of fact, actually follow them all the time. We contrast that decision with the more recent one of Bywater, where essentially we had one guy in Sydney doing everything. Not only was he directing what each board member and how each of them should vote in this quite convoluted list of companies in Samoa and Switzerland and so on, he also organised all of the trades. And the issue in Bywater was that while they were a host of share sales, and they're trying to determine whether or not the companies that these things were bought and sold from were going to be Australian resident. And there the court essentially looked through this sort of sham arrangement and said, look, fundamentally, these decisions are all made by this accountant in Sydney. He's the one doing it. And as such, management and control is going to be in Australia. Now, arguably in this situation, that even if the board in Singapore is accustomed to voting, as suggested by this Australian resident, really its board has still discretion to do what it wants to. It's structured in such a way that they meet inside Singapore and they're not merely just rubber stamping or just following the directions that are made by these Australian residents. So as such, it probably wouldn't be deemed to be an Australian resident company. So here we're looking at resident companies and how when they pay tax, they can pass the tax that they've paid through to their shareholders through the imputation system and use of franking credits. We're also going to look at the rules for small business enterprises. So in this situation, we've got a resident company. It's got a little bit of income, and we've been told that they've made some capital gain and that they've got some deductions. We have to use a little bit of rearranging, a bit of algebra to try and work out what the total income figures were for the year. And our shareholders, we have three that we're analysing here. We've got a David, who's a resident individual. We've got Bravo, which is a resident non-small business enterprise company. And we have Ethel, who's a non-resident. We're going to go through each of those taxpayers, shareholders, and see how this franking credits and these distributions apply to them. So the first thing that we're really trying to do in this question is to determine whether or not this particular company falls under the small business entity rules. And the most important rule, or advantage, I suppose, from being deemed a small business entity is you pay a lower rate of tax. That small business entities are actually taxed at 27.5% rather than the flat 30% rule that all other companies are passed. Now, that may sound like a bit of a boon for small business, and it is to some extent. But as we'll see, with the imputation system, it's not actually quite as big an advantage as one might think it is, particularly when profits that are made and taxes paid, those distributions are then franked and passed on to shareholders. Really doesn't make any difference. But in this particular problem, we've got to determine whether or not this entity is a small business entity or not. Now, the interesting thing about determining whether a business is a small entity or not is that they look at this figure called aggregated turnover. And this aggregated turnover must be less than $2 million. And this term, as is defined in the 97 Act, only looks at ordinary income. And so we're in this sort of unusual situation here, in that statutory income is not taken into account when we're determining whether a company is a small business entity or not. And the component of deductions doesn't come into it as well. So in order to work this out, here we know what the statutory income is. It's the capital gain. We know what the allowable deductions are. We need to just rearrange that formula for determining what taxable income is in order to work out what the ordinary income of this particular entity is. So by default, if we were calculating the taxable income of an entity, we would usually just add ordinary income, OI, statutory income, SI, and we would take away the allowable deductions to reach this figure. So that if we know those other three, we can just look at the taxable income, stat income, and the deductions, and use those and calculate what the ordinary income is as a result. So here, the ordinary income, in order for us to reach that taxable income figure, would have to be $2.5 million. As a result, because this is over $2 million, it is not a small business entity, and therefore it uses the standard company tax rate of 30%. So it's quite a simple formula here. Look, we've got $100,000 worth of taxable income. Therefore, the amount of tax that was payable was going to be $30,000. Thus, the rest of that, the $70,000, is what we can pay dividends. We can distribute to our shareholders. Now, a really core component to the Australian corporate tax system is the idea of the imputation system. And that's this idea that when a company pays tax, it pays tax off, it sends a check off to the ATO, and it does that every year that it derives taxable income. But it actually gets what's called a franking credit. In other words, the amount of tax that it's paid, it can pass on to its shareholders. And it does that through this imputation system. Now, the idea of passing on these credits is known as franking. That's when we send these things on. And the most that a company can pass on to the shareholders is known as this maximum franking distribution. Now, when we're determining what the maximum amount of franking credit that we can attach to a particular dividend is, it's simply the amount of the distribution, so the cash amount that we're passing on to the taxpayer, multiplied by 1 over what we call the gross up rate, and that's it's basically it's 100% minus standard corporate tax rate of 30 divided by 30. Now, by no real coincidence, this value is simply 3 over 7. And so in this very, very simple example, the amount that's being sent, so the cash amount that's being paid out to the shareholders is $70,000. And essentially when doing that, the simplest way of thinking of it is just this franking credit is just basically a certificate that is just paper-clipped to this distribution and given to that shareholder at the same time, with the idea being, hey, the company's earned $100,000. It's paid $30,000 of that as tax. If that's all going to be passed on to the shareholders, essentially the shareholders themselves are going to be deriving $100,000 worth of income, and they are going to be paying tax on that. But the $100,000 component that the shareholders receive is going to be made up of $70,000 in cash and $30,000 paper clipped to that check, which is the franking credit itself. And that $30,000 credit is going to be usable by that resident taxpayer to reduce or offset the amount of tax that they're going to have to pay in the current tax year. So for resident taxpayers, this is pretty straightforward. If, as an individual, you would receive, in this case, they're getting 10%, so they're receiving $7,000 cash and a franking credit of $3,000. So the individual includes this $10,000 in his income, and he basically can put that $3,000 credit towards the tax payable for this year. And with franking credits, if the amount of credit exceeds the amount of tax payable by a taxpayer, then that taxpayer can actually ask for a refund from the ATO. They're refundable tax credits. With a company, the way that companies that receive franked distributions is that they, again, record, in this case, $10,000 as income. $7,000 is just going to be put straight to the bank account. And the $3,000 there is put towards that company's own franking credit account. Now, because the top, company tax rate is 30%, when a fully franked distribution is received by a company, they're never going to have to pay any more tax on that. They're only going to be in a situation where they're just going to be able to put this in their own franking credit account and then pass that on to their own shareholders. Now, with individuals, though, the top marginal rate is above 30%. And so thus, in this situation, where we've got a taxpayer who's on the top marginal rate, this guy's getting a $10,000 additional income. And as a result, he's going to have to pay another sort of $4,700 worth of tax. He can, however, offset that against the $3,000 credit that's included with this distribution. And thus, the liability that David, who's on the top tax bracket, will get is going to be an extra $1,700. With non-residents, though, things are a little bit more complex. Now, when a non-resident taxpayer receives a franked distribution, from the Australian government's perspective, that income's tax has already been paid on that. And so the non-residents aren't entitled to an offset. They can't come back to the Australian government and try and have or ask for credit, with some exceptions where there are double tax arrangements. However, if the distribution has been made unfranked, then all of the unfranked components are going to be subject to a withholding tax. In other words, that when the particular corporate entity is paying these distributions, they are required by the Australian government to withhold a certain fraction, usually 15%, and pay that to the government. Now, in this situation, Ethel, who's this non-resident taxpayer, she's not going to be able to get an offset or a refund. Now, there may, again, be some arrangement if the double tax arrangement between the two countries, Australia and the third-party country, exists. She may be able to get some form of relief and have some sort of credit with there, but otherwise, she's simply going to be taxed twice. She's paid essentially not getting any benefit from the $3,000 that's already been paid, company tax that's been paid and franked and then passed on to her. And she's going to be liable to pay tax on that distribution as well, usually tax on the $7,000 that she's actually receiving. Because as far as the third-party government's perspective is, she's only received $7,000 worth of distribution. She's probably going to have to pay tax at a margin rate in this third country. In this recording, we're going to be looking at a much more complex example. Now, this particular problem scenario involves both having distributions and passing franked dividends to shareholders. We're also, though, going to look at the offset system. We'll go through the actual rebates that are available to resident and some non-resident taxpayers. So in this situation, we have a closely held family company, and it's based in Brisbane, and the only income that it has in a particular tax year was disposal of an asset, capital asset, a depreciation asset. So we're going to go through and do the depreciation calculations here. And during this particular year, the entity also paid a fully franked $10,000 cash dividend distribution to one of the shareholders. Now, as you may be aware, that distributions, dividends to shareholders can't be done out of capital, got to be done out of profits, out of income that's been derived throughout a particular year or through reserves. And so we're going to calculate what the actual income for the entity was, and for the assuming that the amount of $10,000 that's been distributed through cash dividend is less than what the income of this company is, we're going to find out what the other shareholder, which is the wife of this particular shareholder, what amount that is going to be distributed to her, given that he is on a high marginal tax rate and she is on a low marginal rate. And we've got some other, I guess, more personal issues here as well. First thing is that for 3/4 of the year, she's moved from Brisbane to Townsville permanently to look after her sick mother, who is actually a disabled person within the meaning of the Social Security legislation, and has a pension. The wife also has an income of her own of $10,000, and they both are up to date with their private health insurance. They've been paying $200 a month for the family, and have done so for a long time. We're going to be going through and looking at all of the offsets that are going to be available here. We're also going to examine what's going to happen if, instead of moving to Townsville, that the ailing mother was in fact overseas, either in Indonesia or in New Zealand. And I must say from the outset that this style of problem is in quite a bit more depth than one would expect us to assess the students in an undergraduate taxation course. It is, however, authentic. In other words, these are all of the rules that you'd need to know if you are actually going and preparing a tax return for a resident taxpayer with these particular situations and circumstances. So the first thing we're going to look at is, well, what's the amount of that we can deduct for depreciation for this particular asset? How has this actually been accounted for, and the tax deductions claimed in the previous 2 years? Because we're looking at tax year 3, we've got to really determine how what the opening value of this asset is going to be in order to determine what the balancing adjustment is. So in tax year 1, using the simple contemporary formula for depreciation deductions, this formula is found in 40-72, and for the first year it's simply the cost multiplied by the days held divided by 360, multiplied by 2, and then multiplied also by the asset's effective life. For the first year, this base value is the cost. For subsequent years, it's the opening value of basically what it was from the previous year's end. The asset's effective life is usually determined by the commissioner. You can, usually in unusual circumstances, determine it yourself and put a reasonable estimate in for the commissioner to use that. But in this particular situation, we're given the effective life of 10 years. And so for that first year, it's straightforward. It's simply a $100,000 asset. It's multiplied, it's been held for the whole year, so it's just multiplied by 2 and divided by 10, so it's just $20,000. So as a result, in tax year 2, the opening value is going to be $80,000. And again, we're using the diminishing value method, so we're just multiplying by 2 divided by 10. And so in that second year, we're going to have $16,000 worth of depreciation deduction. So that the opening value for tax year 3 is going to be the amount that we started with, the $100,000, less all of the depreciation will add up. There's no mention of any private use percentage here. So therefore, the amount that we're going to be looking at when we're trying to determine what the adjustable value of this asset is, in other words, the book value, tax purposes, is $64,000. Now it's been sold, and it's been sold for more than not just what we paid for it. It's also been sold for more than what its present adjustable, essentially its book value is. And so they've made a statutory income, a capital gain on this asset of $56,000. That is the only transaction for the year. So as a result, the amount of tax that's going to be payable on $56,000 worth of income is going to be $16,800. And because this is a company, what they do with this amount that's been paid to the ATO is that they record that in what's called their franking credit account. Basically, this is an amount that this company can pass on to its shareholders through these franked distributions. But it is important to note here that the amount of actual cash of money that they're allowed to distribute can only be taken out of the after-tax profit. And so here we look at what the sort of base profit figure is, of $56,000, take away that $16,800 to reach this maximum amount that we can pass on to shareholders in cash distributions, which is $39,200. It's also useful to just note here that because there's no private use, there's no capital gain consequences, no CGT consequences there. In earlier recordings, we had examined the capital gain implications of this, but basically it's only to do with really this private use percentage that an asset might have, and just essentially just reversing that out. And so here there's no mention of any private use, and as such there'll be no capital gains tax implications for this particular asset. Now the question sort of states, hey look, we want to pay the absolute maximum. We want to include maximum franking credit that we can when we're paying it to the first of these tax rates, to Alex. So basically, the question states that look, $10,000 has been paid to this guy. Now, that $10,000 here is made up of cash, but it also has attached to it a component of franking credits. However, corporate entities simply can't just attach any amount that they could possibly like as franking credits. Essentially, this is that money in the hands of its shareholders. I mean, can be converted into cash. You can actually go to the ATO and ask for a refund in most circumstances. Now, this $16,800 that's gone into the franking account is the maximum we're allowed to pass out. If for whatever reason more than that's passed out, then something called a franking deficit tax, franking credit deficit tax, will apply at a punitive rate to that corporate entity if they, for whatever reason, pass it out more to the shareholders than what they had available to distribute. And so here, it's by no coincidence that we look at the amount of tax paid, and then we go through and again multiply it by 7 divided by 3, which is the gross up factor, 100% minus the standard corporate rate of 30, divided by 30, the standard corporate rate. It's by no coincidence that when we go and just essentially just check this figure, that it comes back out at $39,200. That, of course, is the figure, which is the maximum amount that we can distribute. So when calculating the amount of franking credit that we can pass on to Alex, who's one of the shareholders, we start with the amount that the cash dividend is, which was $10,000. And we just multiply that by 3 and divided by 7. That is the maximum amount of franking credit we can attach with that distribution. And so here, in that situation, that the two are combined together, so it's $14,285, and that's just going to be added to the guy's taxable income. Both of those components add to the income of the taxpayer. In other words, in their hand, they're both taxable income. Here, though, he's already at the top tax bracket. So, assuming that he's sitting on $180,000, when we're adding that to him, he's going to have to pay the difference, because the maximum that we can actually frank these things is not going to be to the same extent as what the top marginal rate is, including the Medicare levy and the budget repair levy. And so as a result, Alex is going to have to pay an additional $2,715 for that, for the additional tax based on his marginal rate after the offset from the franking credit is taken into account. Now, after this distribution is made, the corporate entity that is paying the distribution has to reduce their franking credit account by that amount, by that $4,285. As a result, there's only going to be $12,515 remaining that we can pass on to the other shareholder. And again, taking that amount, $12,515, and applying the gross up figure of multiplied by 7 divided by 3, will reach the maximum amount that's available to be passed on. It can be paid as a distribution through to the second taxpayer, to Joan, who's the wife in the situation. Now, another important thing to note from a very practical perspective is that where you have couples or family units and you're doing tax returns or tax accounting for those, you often need to calculate the other partner's income in order to determine the family entitlement, or each of the individual people in this relationship's entitlement to certain rebates. And so the next part of this question, before we apply this distribution to Joan's taxable income, we have to calculate these things and then go back and look at what could possibly be applied to Alex's income as well in terms of a rebate. Now, the first thing to note, and this is really a general principle of company law, is that when you establish a company, you can create different classes of shares. They don't all have to be the same type. Shareholders can have different quantities of rights, both in terms of voting rights, and they can also have different sets of rights in terms of entitlements to distributions. And so it's quite a common thing for closely held companies, so say the family controlled entity here, for there to be sort of one class of shares owned by one family member and another class owned by another member. And that can be quite a useful mechanism for distributing dividends based on how those family members are sitting in a particular tax year in terms of their own marginal tax rates. So here in this problem scenario, Alex, the husband, has a very high marginal tax rate. And so it's preferable for the family unit to apply dividends and distributions to the wife, to Joan. Now, the problem scenario states that $10,000 has already been paid to Alex, and really we're looking at the remainder, presumably because they've now come to you as the tax accountant to really determine, well, what's the situation here? How can we go about maximizing or minimizing the tax we're paying and maximizing our position by applying the remaining distributions to Joan. And And in doing that, we're also going to look at the various rebates that are available to her as well. Now, the important thing to note about franking credits is that unlike other forms of rebates that can be the taxpayer can become entitled to, the franking credits can actually be refunded in part or in whole back to a particular resident taxpayer. And so the really important thing you need to note here is that when you're applying rebates and offsets to a particular taxpayer in a particular year, you always want to be applying the non-refundable ones first. And that's kind of logical. Applying the non-refundable ones and offsetting that against any tax payable means that if there's the amount of offsets is more than what the amount of tax payable is, any of those that derive from things like franking credits can be refunded in cash back to the taxpayer. Whereas some of these other ones that we're talking about here, for example, the low income tax offset, the dependent invalid and carer tax offset, the zone tax offset, and the private health insurance rebate, these are non-refundable. Now, it is not uncommon in practice to come across people, taxpayers, who are in these situations, and in some ways it can be a little frustrating in that certain aspects of social policy that generally are governed by agencies such as Centrelink have, for often long-standing, sometimes political reasons, been included in our taxation system. And so, for example, each of these offsets and rebates that we're analysing here are all from the 1936 Act, things that have been in the system for a long time. So starting with the low income offset, basically resident taxpayers who earn less than $66,667 can have some form of rebate that is incorporated inside their return and will reduce the amount of tax that's payable. We haven't mentioned this earlier in this course because these sorts of rebates have historically, and for unfortunately quite a long time, sort of been on the radar of governments to really try and be scrapped. In this particular situation, the low-income tax offset applies. It's basically a $445 tax offset you get that is reduced for every dollar. It's reduced by 1.5 cents for every dollar you earn above $37,000, reaching zero at $66,667. And so here, where we have Joan, who's the wife, her taxable income from other sources is $10,000, and we've added that to this distribution that she is receiving from this company of $29,201, and so her total income is going to be $39,201. So as a result, this is between $37,000 and $66,667. So we start with the base amount, the $445, and then that's reduced, and so that amount that reduces it down to $412 as a non-refundable rebate. The next rebate we're going to look at is the invalid and carer offset. Now, this applies to situations where people are looking after usually close family members, and it only actually applies if that close family member, the invalid, is receiving some form of pension from the federal government. So it's only going to apply for people who are looking after resident, usually elderly parents, sick children, and those children or parents are in receipt of some form of government pension in order for this to apply. Here also in our problem scenario, the taxpayer is caring for the invalid parents for only 3/4 of the year. Now, in each of those situations, the amount of the rebate is reduced, so that the base amount, which is a rebate of $4,423, is reduced for the amount that this particular invalid is not being looked after, which is 1/4 of the year, which is $605. And we have to take into account the income of the person being cared for as well. And so basically the amount of this rebate for Joan will actually be reduced the more income, again usually through pensions, that her mother is going to receive. So in this problem scenario, her mum receives $8,000 for the year, but only $6,000 of that's going to apply because she's only looking after her for 3/4 of the year. And so in this situation, it's actually reduced for every $4 earned by that particular invalid above 282. That reduces the amount of rebate by $1. And so here, that the sum there is $1,429. So as a result, the base offset amount is reduced by both the reduction for part year care and for this 3/4 of the year's worth of the invalid's income. And as a result, the offset that Joan is able to claim is going to be $389. Now, the next thing, which is a rebate, which is quite dear to our hearts. Why? Well, the institution that the subject is taught in is taught in both Cairns and Townsville, and sometimes more remotely in Queensland, North Queensland. Why is this important? Well, the federal government, its infinite wisdom, actually gives every taxpayer who resides in this area for over half of the tax year a straight up $57 rebate. However, there's actually an additional component here. And the reason why we're doing the zone tax offset after doing the dependent and carer offset is that there is an additional component in the zone taxable offset that is derived from the amount of offset that you get in the earlier part of this question. So in the earlier part, the dependent offset that Joan is receiving was $389, and she actually gets an additional 20% of that included and added to the offset, the regular zone offset of $57. And the way the zones are calculated, there is a list that's generated by the federal government. It's in Schedule 2 of the old in the 1936 Tax Act, and it just lists the various places that are either considered regional, such as Townsville and Cairns, or remote, so places like Mount Isa. And the idea is that the rebate is larger for these remote areas, and it's still quite minor, but it's a base of $57 for taxpayers in Townsville and Cairns. Now, the next component is the private health insurance rebate. Basically, if taxpayers have an appropriate level of private health or medical insurance, then they get a rebate on their tax payable. And in some circumstances, they can just apply that against the premiums for paying for subsequent amounts of medical insurance. This is quite complex. The amounts, the percentages are indexed, and they are issued by the Department of Health, not the tax office. And the year in which that they do this actually runs from the 1st of April. And so as such, in any given tax year, the taxpayer is going to have usually 1/4 is going to be at one rate, and the other 3/4 will be at another rate. Now, the amount of the percentage that's used depends on the family's income in this situation. See here, the family income is going to be between $210,000 and under $280,000. So it's going to be in this tier 2 of calculations. So here, the percentages for the first 9 months of the tax year is 8.93 for these tier 2 taxpayers, and for the final 3 months, it's 8.644. So to calculate this rebate, where we've got taxpayers paying the same amount each month, it's quite an easy calculation, just 9 months times the amount they're paying, which is $200, multiply that by that first rate, and then just add to that 3 months, again with the same amount being paid at the second rate. Find that amount for the rebate, which is $213. So when putting these together to determine this taxpayer's liability, we just have to quickly check to see whether or not she's exempt from the Medicare levy, either in part or in whole. And in the situation, she's not. In fact, her income just on its own exceeds the family threshold. So when taking Alex's into account, it's vastly over that. So she's going to pay the full amount of Medicare levy, which is 2% of her total income. Her base tax payable from the Income Tax Ratings Act is going to be $3,570 plus 32.5 cents for each dollar she earns above $37,000. So the total there is $4,287. And so here we've listed all of the offsets, franking credits, $12,515, and the 4 rebates that we've calculated. The important thing to note here, and the last thing, is that when doing this final calculation, always use the non-refundable offsets first. So after applying that against her tax payable plus Medicare rebate, we have $3,922 still owing. Then finally we take the refundable franking credit offset and we subtract that from that amount that's owing, and we get quite a large refund, $8,593. That'll be refunded to her from the ATO after she submits her return. So the next step is to go back and just re-examine Alex's tax liability. Now we've calculated his taxable income to be in the top bracket of $194,285. And as a result, his tax liability, which is taken from the Ratings Act, is going to be a base of $54,232. Then there's an extra 45 cents for each dollar he earns above 180. And there's also the extra 2 cents per dollar earned above 180 from the budget repair levy. Also, because his income alone exceeds both the single and the family thresholds to get some sort of Medicare levy reduction, he's going to be liable for the entire Medicare levy. But he won't have to pay what's called the Medicare surcharge. That's for people who, after the age of 31, haven't had continuous private cover. Here, the facts suggest that he has since the age of 25. Also note, he can't claim any of the other rebates that Joan could in the earlier one, with the exception of the private healthcare rebate, which could actually be applied to either his income or to Joan's. Now, at this stage, we don't know how much tax, in terms of PAYG, that Alex has already paid through to the tax office and how that sits in terms of rebates and other such things. However, Joan, it doesn't really matter because Joan's already absorbed that into the amount of tax that she had to pay. In other words, she's applied all of the non-refundable rebates against her tax bill, and it still didn't offset the entire amount. And so it really doesn't matter how we go about doing this from this point, regardless of what Alex's present situation is, in terms of which spouse is going to claim that particular rebate. Now, finally, we're going to look at what would happen if Joan in the situation was non-resident. So the first thing to know is that when a non-resident is getting franked distributions, most of the time they're not going to be able to get the benefit from that franking credit unless there's some sort of arrangement between the countries. What you generally find is that if there isn't this arrangement, the other country where this particular individual is now tax resident is just going to look at the amount, the cash which that taxpayer has received, and just tax them on that. And so there's no real benefit for doing that. Now, you might sort of think, well, what would then be the benefits of having a frank distribution at all? And to some extent, you're right. However, where either partially franked or an unfranked distribution is made from an Australian resident tax company, withholding tax is required to be withheld. And so that is just simply paid to the ATO, and no credit is going to be available there, again, unless some double tax arrangement is in place. Also note that as non-residents, none of the rebates are going to apply. So in this situation, we would look at, and again, if this was a complex problem in some form of assessment, we would definitely examine, well, what's the indicia here? Is she actually a non-resident? So we would go through, look at the tests of residency for individuals, the 4 limbs of that test, the common law test, the domicile, the 183 days, or the superannuation test, and just ensure that none of those are going to apply. And so here, that the key part is that, assuming that she's going to remain Australian domicile, she's Australian citizen and such like, her permanent place of abode have to be overseas. Now, there's a key difference, though, between being a non-resident Australia and being resident of Indonesia as opposed to New Zealand. And the important thing there is that the New Zealand and Australian governments have a very, very close relationship, and this trans-Tasman relationship means that franking credits and the equivalent imputation credits from New Zealand companies can be mutually recognised by the other countries in full. Essentially, there's full recognition of those, and so they can be included, and the credits from those can be incorporated if you're a resident in either of those 2 countries.